Right now, as of 11:10 a.m. Eastern Time, Beyond Meat, ticker BYND, is trading live at $2.30 per share. That is a massive move of 27% to the upside on the day, a 49-cent gain from yesterday's close. We are seeing absolutely astronomical volume with over 204 million shares already changing hands, compared to a normal average in the single-digit millions. Now, when most people see a 27% intraday spike on a name like this, especially after the 1,600% rally it just had last week, the immediate, overwhelming expectation is that the short squeeze is back on. The narrative you will see across social media today is that the retail army is back, fighting to push the stock higher after it pulled back 17% yesterday. The belief is that this is a continuation of a GME-style war against the short sellers. But the on-chain data and the company's own filings reveal a completely different and far more complicated reality. This is not the simple short squeeze everyone thinks it is. In fact, the entire premise of the recent 1,600% rally was based on a massive, fundamental misunderstanding of the company's financial structure. What we are seeing today is not a squeeze. It is the chaotic, speculative aftershock of a company that just saved itself from bankruptcy by drowning its existing shareholders in one of the most dilutive events of the year. The common belief, the one that fueled the run from 50 cents to over $8, was that the short sellers were trapped. The expectation was that short interest was over 100% of the float, a setup for an infinite squeeze. This narrative spread like wildfire. But the reality, buried in SEC filings, is that Beyond Meat management executed a death spiral debt conversion to survive. They had over $1 billion in 2027 debt that they could not pay. So they struck a deal to exchange that debt for shares. This single move, a tender offer, created 316.2 million new shares, increasing the company's outstanding shares by nearly 5 times. This is the piece of the puzzle that the squeeze narrative conveniently ignored. The company saved itself from insolvency, which is a positive, but it did so by diluting everyone who held the stock into oblivion. The reason the stock is now trading at $2.30 and not the $200 it saw post-IPO is that each share now represents a tiny fraction of the company it once did. Today's 27% jump is just raw volatility, a hot potato trade in a stock that has become unmoored from its fundamentals and is now a pure speculative vehicle. Let's break down the recent mechanics because it is a textbook case of market psychology. The rally last week was triggered by some genuinely positive, albeit small news. First, the company announced an expanded distribution deal with Walmart, placing its new Beyond Burger 6-pack in over 2,000 stores. This is a tangible, positive development for their struggling retail sales. Second, last Friday, the company released preliminary third-quarter revenue figures, expecting around $70 million. This was slightly above Wall Street's dismal estimates of about $69 million. They also announced they won a favorable ruling in an arbitration case. These small bits of good news, combined with the stock trading at a desperate 50 cents, were enough to light a match. But the explosion only happened because of the false short squeeze narrative. Retail traders piled in, thinking they were trapping the shorts. This brings us to the most important part of this analysis, the short selling data. This is where investors must learn to look past the social media hype and find the real numbers. The expectation, as reported by some data providers and repeated endlessly online, was that short interest was as high as 80, 90, or even 109% of the float. This was the entire thesis for the squeeze. But that reality was based on old data. It was calculated using the pre-dilution float of around 65 million shares. The moment the company issued 316 million new shares to convert its debt, the float ballooned. The most recent and accurate data from sources like Fintel, which accounts for the new share count, shows the short interest is 51.8 million shares. This is now only 14.5% of the new massive float. To be clear, the short interest is not 109%, it is under 15%. The squeeze thesis is and was factually incorrect. The 1,600% rally was not a squeeze, it was a speculative frenzy based on misinformation. How can a regular investor verify this without getting lost in the noise? Don't just look at the short interest percentage. Look at the cost to borrow. This is the fee short sellers must pay to borrow the stock. Data from last week shows that on October 15th, the cost to borrow Beyond Meat shares was an astronomical 894%. This was incredibly high, indicating a severe scarcity of shares and high demand to short. That was the real pressure. Today, the cost to borrow has collapsed to a perfectly normal 8.29%. This is the smoking gun. It proves the pressure is gone. The shorts are no longer trapped, and it is no longer expensive to bet against the stock. The shorts who were betting on bankruptcy, the 2027 debt, did lose because the company averted it. But the shorts who were betting on the stock's fundamental value being low were, and are, arguably correct. This is a complex situation. What's your take on this? Was this a genuine retail movement, or was it a massive frenzy based on misunderstood data? Another piece of evidence for investors to track is the fail to deliver, or FTD data. This SEC data shows when one party fails to deliver shares to another at the settlement date. In late September, BYND saw a massive FTD spike of over 8.7 million shares. This can sometimes indicate naked shorting or other settlement issues. This spike likely primed the stock for its initial volatility, but it was the subsequent dilution event that completely changed the game. What investors are left with now is a company that is fundamentally on slightly better footing because its balance sheet is clear of that crushing debt, but its stock is now almost infinitely diluted. Today's 204 million shares traded is just noise, with high-frequency algorithms and day traders swapping shares back and forth, scalping pennies on the volatility. There is no major institutional buying here. This is the opposite of smart money movement. For anyone new to this story, it is important to understand what Beyond Meat actually does. The company was a Wall Street darling after its 2019 IPO, promising to disrupt the global meat industry with its plant-based burgers, sausages, and other products made from pea protein. The expectation was that consumers would flock to these healthier, more sustainable alternatives. They secured high-profile partnerships with McDonald's and Yum brands. But then the reality of consumer behavior set in. After an initial trial, repeat purchases plummeted. Consumers complained about the high price, the processed taste and texture, and a growing skepticism about whether these products were truly healthier than real meat. Sales collapsed. The company began burning through hundreds of millions of dollars, leading it to the brink of bankruptcy where it was just 2 weeks ago, trading for 50 cents. This is the fundamental backdrop. The company does not have a short problem, it has a demand problem. So, what is the future outlook from here? The board of directors has successfully executed a hard reset. The immediate bankruptcy threat is gone. That is scenario 1, the bull case. The company is now a clean shell. It has its new Walmart deal and a slight beat on revenue expectations. The new expectation is that this leaner company, free from its debt payments, can now focus on stabilizing its business, cutting costs, and perhaps, just perhaps, slowly rebuilding demand for its products in a niche market. In this view, the stock is trying to find a new stable bottom around the $2 level, and today's 27% pop is a sign of life. Scenario 2, the bear case, is far more probable. The reality is that the company solved its debt problem by destroying shareholder value. The float is now so large that any significant upward price movement would require a truly massive, sustained inflow of new buying, which is unlikely given the weak fundamentals. The bear case argues that consumer demand for the product is in a permanent decline, and no amount of financial engineering can fix that. In this scenario, today's 27% jump is a dead cat bounce, a final volatile spasm as the meme stock crowd moves on to the next shiny object. The stock will likely bleed back down as the extreme volume fades, and the market realizes that a 15% short interest cannot and will not trigger a squeeze. The actionable takeaway here is to be skeptical. When a stock's narrative seems too good to be true, it almost always is. Investors must look at primary sources. The story was never shorts are trapped at 109%. The story was company issues 316 million new shares to avoid bankruptcy. Those are two very different things. As an investor, your job is to find the signal in the noise. The borrow rate collapsing from 894% to 8% is the signal. Today's 27% jump is just noise. Comment below with your thoughts. Do you think Beyond Meat will even be a company in 2027, or was this entire saga just its final speculative gasp? In the end, the Beyond Meat story of the past 2 weeks is a historic clash between expectation and reality. The market's expectation was a GME 2.0, a heroic retail-led short squeeze. The cold, hard reality was a desperate, dilutive corporate restructuring that fundamentally broke the short squeeze thesis before it even began. The stock's wild ride was a fever dream, and what we're watching today is the market waking up, confused, and trying to figure out what this company is actually worth now that the narrative has evaporated.